So we're in chapter 9, and chapter 9 works to get around some of the issues I discussed last week and what have you with, you create a budget, and then by the end of January, you realize, okay, it's not working, or it's not, we've already blown the budget. What do we do now? You know, and do we just mark the next 11 months off as kind of a lost cause, or do we kind of see where we are? So here in chapter 9, we're going to do a flex budget, and we're going to use these to kind of take our budget and say, okay, we thought we were going to do, you know, 1 million units, or we thought we were going to do 100 units, and we did 1,000,005, or we did whatever. Can we adjust our budget without necessarily going through the whole thing? Okay. And so chapter 9 here is going to talk about a couple of different types of variances. And then chapter 10 next week, we'll talk about a couple other different variances. So that's kind of the plan, is to flex our budget and then see how we did compared to, hey, if we'd had our budget correct, how would have we done? So with that being said, I am going to start with exercise 9.1. I'm on page 425. Oops. I'm going to be on page 425. And we'll start with exercise 9.1. And this just has us flex a budget, okay? And notice what they have there. They have a budget, and this is for May. And a quick note, they have the nice headings there. Should you probably put the nice headings? And the answer is yes. Am I going to, you know, shortchange them a little bit? And the answer is yes, just in the interest of you having to tolerate my writing here and what have you. And notice for that planning budget, what they have there, they budgeted 100 hours, and they actually had, notice it says 105. Okay. And so it says to prepare a flexible budget. And one quick note, that's usually one of the problems on the final exam, is to flex a budget. Okay. So y'all know I put a problem or two on there. This is usually one of them. We'll talk about that in a couple of weeks when we're closer, but I frequently do that. So what we're going to do is modify it to 105 units. And notice their expenses there, and I'm looking at their planning budget, whatever. They have some that are what we call mixed costs, wages and salaries. It's got a fixed portion of $8 grand plus 125 times Q. So that's kind of what we call a mixed cost. Supplies there are purely variable at $3, and insurance is pure fixed cost at $3,400. So they've kind of put, you know, they've got all different types of costs in there. So that's kind of what we're doing. And beyond that, flexing the budget is not a terribly difficult thing to do, because all we're going to do is modify our budget based upon those new numbers. So we're going to do a Puget Sound. And we're going to do a flexible budget. Okay. And you would just kind of a quick note, you would do this after the month. And the reason why chapters 9 and 10 are both dealing with the idea of how do we evaluate how well we did? Okay. Just because we made more money, or just because costs were lower, does that necessarily mean we did a good or a bad job? And so these two chapters, 9 and 10, give us a way to evaluate how well we did. So we're going to flex the budget for the month of May. Okay. And we would do this, just kind of a quick note, after the month of May was over. Now, we may change the budget going forward, but we're probably going to do this after the month has passed, because we know now what the actual number of hours worked. So we've got actual driving hours. Is 105. Okay, and that's going to be the number that we're going to use for everything. Okay, that's going to be our Q, if you will. It's going to be our Q. Okay, so the first thing is revenue. Okay, and it's going to be, and I'm going to put the formula here just so we've got it. We're going to go 365 times Q. Chris, we're doing exercise 9.1. We're on page 425.
Sounds good. Thank you.
So we're going to take 365 times Q, and that'll give us our revenue of 38,325. Okay. And so that's what we're going to do for our revenue. Now we're going to do our expenses. Okay. And the first one is wages and salaries. Okay, and the wages and salaries is going to be eight. I'm just going to go ahead and do it for all of these. I won't do it after this, plus 125Q. So we've got 8,000, which is the fixed portion. We take 125 times 105. And when we sum those up, we should get to 21,125. So that's our wages and salaries. Next were supplies. That's 3 times Q. So it's 3 times 105, so it's 315. We're going to do equipment rental. Which is going to be 1,800 plus 32Q. And that'll be 5,160. Then we have insurance. That's a flat 3,400, so that's one of our fixed costs. We have miscellaneous, which is 630 plus $1.80 times Q, which is 819. So if I sum all those up, my total costs or total expenses are 30,819. And if I really had done it a little bit, so I'm going to take that 38,325 minus the 30,819 to get my net income. And they called it operating income, so we'll go with that. And that's 7,506. So that is how we go ahead and flex a budget. Okay. What that tells me is that even though my budget at the beginning of the year, whatever, for the month of May was going to be 6,490. Okay. My budget is 7,506 when I flex it for how many I've done. Now it doesn't tell me how well I've done yet. Okay. We've got to do one other part. This is just the budget part. Okay. We should have made 7,506. Now the question would be, okay, how much did we actually make? Okay. So what we would typically do is we typically take and have another column. We'll see where here on the next problem, either there or there, and then we'd compare them. Okay. So this is just the budget part. We've got to take it one step further to actually make it useful, if you will. Questions? we're going to just turn the page and go to 9.2. Okay. And this one requires really no math. Okay. And I'm saying that it really, what we're going to do is we're going to take that top planning budget and put it next to that flexible budget, which is the one right underneath it. So we're just going to copy those numbers down. Okay. And figure out variances. Okay. One other quick note for this one, I am not going to put the formulas. I'm just going to have like revenue or what have you. Okay. This is where these budgets become valuable, what have you. Okay. This is where these budgets become valuable. So in this particular case, we're going to calculate activity variances. Okay, we're going to go ahead and calculate an activity variance. Okay, and we have it, it's for the flight cafe. Okay, and once again, this is an activity variance. And once again, it's for the month ended. And the real reason why we do these headings, what have you, is so that somebody else picks this up, they can see what it's for. They don't have to guess or what have you. And now what we're going to do is we're going to have 3 columns, okay? And I'm going to put them the way the book has put them and what have you the way, but in reality, it doesn't really matter other than the fact that you just have to be careful when you're calculating the variance. So we're going to put your textbook puts the flexible budget in the first column. It's going to put the planning budget in the second column. And it's going to put the activity variance in that third column. And it's really this that we're worried about. Okay, keep in mind, we just did a flexible budget the last problem. We put that together. The planning budget would have been done, the year before or whenever. And then the activity variance is the number we're going to calculate here. So we'll start with meals. And it's 17.8 and 18 grand. And we don't figure out a variance for the number of meals, okay? We don't figure out a variance for the number of meals. And all I did is copy them right off the 2 tables, okay? And I'm copying the bottom table there in the first column and the top the top table in the second column. So now I've got revenue. Okay, and my revenue under the flexible budget was 81.8, and on pardon me, 80,100. I am just an interesting thing is I just kind of made that number up from anywhere. 80,100 and 81,000. Now the difference between those two is $900. Okay. That's $900. And then the question becomes, is it favorable or unfavorable? Okay. Well, our planning budget was 81. Our flexible budget was 80,000. So it is $900 in what we call unfavorable. Okay. And really the reason is we didn't have as many meals as we anticipated. Okay. So that's what we have there. Then we'll have expenses. And really, once again, this is just other than that last column. We've got raw materials. And the raw materials were 42,720 and 43,200. So the difference between those is what? 480. 200, yep, 480. And now, okay, and just a quick note, this is one of those spots where, you know, we got to keep our thinking cap on. This is going to be favorable, okay? And you go, but it's, you know, the flexible budget is lower. Yes, but it's an expense that's lower, so that makes it favorable, okay? Now, this is where these flexible budgets come in handy, and we're going to see this on the next problem when we even add, I think, one more step here, one more item. It'd be very easy if the actual numbers came in at 42,720 and somebody say, hey, look at this, I'm such a great manager. My expenses for raw materials were less. They were favorable. And you go, yeah, but we didn't do as many meals, so they should have been favorable. Okay, so what this does is it gives us now a way to compare, you know, what the actual was. And in fact, here on the next problem, I believe I've got one where we're going to put the actual number, an actual column. Okay, because that's really what we want to see. So my raw materials are 42,720, which is 480 favorable. My wages, are 10,540 and 10,6, which is $60 favorable. And let's see, that's wages and salaries. Utilities. The utilities, 3,290 and 3,300. $10 favorable. Rent. And insurance. So those don't have any variance. Those don't have any activity variances. Okay, and then we have miscellaneous. And miscellaneous were 2460 and 2480. Which is $20 favorable. And then we need total expenses. And total expenses, 65,610. 66,180. 570 favorable. And a quick note, that 570 is just the sum of all those as well as the difference between those two. Okay, so that's 570 favorable. And that gives me net operating income. And net operating income 14,490. 14,820. And 330. That one is unfavorable. Okay, unfavorable. Now, this to me is not the critical part of this chapter. And the reason is all of these variances are 100% explained by the fact that I didn't do as many meals. You know, if you're a car wash and you didn't wash as many cars, are you going to expect revenue to be down? And the answer is yes. Are you going to expect expenses to be, down? And the answer is yes. You didn't do as many cars. Okay. And you can go through a whole bunch of businesses. I didn't serve as many dinners. I didn't serve as many meals. I didn't perform as many emergency room procedures. I did, what have you, or you did more. Okay. And just because it's unfavorable here, it doesn't tell me a whole heck of a lot because I already knew that I didn't do as many meals. Okay. And the fact that revenue was unfavorable and all of my expenses were favorable doesn't tell me a whole heck of a lot, because that should all be expected based upon the fact that I didn't do as many meals. So in many ways, this activity variance, it's okay, but it doesn't tell me a whole heck of a lot. What I want to do is I want to find my revenue and spending variance. Okay. So let's continue and take go on to exercise 9.3, and I am on page 426. This is the one report that I would argue is the key to chapter 9 and the most beneficial. Okay, and the most beneficial. So what exercise 9.3 does is it gives us, notice what it gives us in this case, it gives us two tables, but now it gives us the actual results and the flexible budget results. Okay, so what we're going to do, and I'm not even going to try to pronounce the name of this company, Quilcena Oysteria. I have no idea. I must pack oysters or something. But this is the most beneficial of the reports here and the ideas from chapter 9. So we've got this company, the Oysteria. Not even sure if that's really a thing. Okay. But what we're going to do is what we call revenue and spending variances. And once again, it's going to be for the month ended. Okay. And notice what we're going to have. Let's create our three columns. We're going to have actual results. We're going to have the flexible budget. And we're going to have revenue and spending variances. So those are going to be my three columns. Okay. Now notice I don't have a planning budget here. I just have my actual results in my flexible budget. So now what I have is I have pounds. These are pounds of oysters or what have you. My actual results were 8,000. I have flexed my budget for 8,000. Okay. Now I have revenue. Now my flexible budget at $4 a pound is 32 grand. Okay. My actual results though were 35.2. So that is a $3,200 favorable variance. Now that's a good thing because notice I flexed my budget so it represents 8,000. My actual results is I sold 8,000. I would have expected 32,000 pounds in revenue. I really had 35.2. Maybe it's a market price thing where I was able to get more, okay, for it. Obviously, I was able to sell it at a higher price. Maybe I had a customer that was willing to pay that higher price. Maybe it's a higher, for whatever reason, I was able to get more revenue from the same number of pounds than I would have expected. So that's a good thing. Okay, that's a good thing. So now let's go ahead and take a look at my expenses. And for my expenses, I have packing supplies. Okay. And this was 4 grand here. It's 4,200 here. So this is a $200 unfavorable. I spent more than I should have on packing supplies. And this is where, from a management standpoint, the boss would always come to me and go, okay, Ralph, you should have spent 4 grand to pack 8,000 pounds. You actually spent 4,200. Why? Well, some of the boxes were damaged because we left them out on the shipping, dock and they got wet. Or the price of cardboard went up. Or whatever else goes into these packing supplies. I don't know. Those are the two that come immediately to mind. But now all of a sudden I've got something to say, okay, explain this. And maybe it's explainable. Maybe my employees didn't know how to properly put the boxes together and damaged them. And the reason why that's important is now maybe I can, in the future, give them better training, or I can, make sure the boxes aren't out as long on the dock and I get them into the warehouse quicker, or whatever it might be. Okay. That's where I can take and use this to hopefully make my operation run better. Okay. And as a manager or as an employee, and I was the employee when I was doing these types of things, they would come to me and they just say, explain. And then I'd have a column over here where I would put my handwritten comments. Okay. And explain why, and it's usually, if it's $1 off, no. And usually it's based on percentages, and whatever the boss thinks is an appropriate percentage. They used to either highlight things they wanted explanations for or circle them, what have you. And then I'd offer the explanations for those particular items. Okay. But that's how this is then used as a management tool. So continuing on here, oyster bed maintenance. Okay, and it was 3,100 was actual, 3,200 was the flexible budget. That is $100 favorable. And the key here is just because it's favorable doesn't necessarily mean it's always good. Okay, and you go, but expenses were less. Yes. but were they why were they less? Okay, and you know, $100 on 32 versus 30 may not be much. Okay, but the question that comes up with some of these, especially maintenance things, are you shortchanging maintenance and it's going to cost me more later on? Okay, because you went cheap this month on oyster maintenance for whatever, and I don't know what exactly that is it now going to cost me, in the case of oysters, perhaps more deaths down the road? If I cheat on changing the oil on the vehicle, on the trucks, okay, is it going to cost me a major repair down the road? That, yeah, you saved me $50 this month on an oil change, but it's going to cost me $3,500 for a new engine. Okay, so just because they're favorable doesn't necessarily mean they're good. Okay, wages and salaries. And the actual amount spent was $56.40. The budget was $5,300. So that is $340 unfavorable. Okay, $340 unfavorable. Now I'm on to shipping. And for shipping, I have $69.50. And I have $6,400, which is $550 unfavorable. And now all of a sudden, and once again, I have no independent knowledge of what's going on, but there may be an explanation for this increased revenue. Okay, I had smaller orders this month. And on smaller orders, we charge more per pound. Okay. And why was the revenue favorable? Because we had smaller orders, and on smaller orders, we charge more per pound. But that also meant that shipping costs went up because we had to put it in more boxes and we had more shipping, postage, whatever, because we had smaller orders. Okay. Might there be explanations like that? The answer is heck yes. Okay. And that's a lot of times what the boss is looking for. Okay. Now we're on utilities. And it's 810, 830. That's $20 favorable. And there may be some utilities, I'd argue, yeah, who knows, you know? Somebody left the lights on perhaps or something. And keep in mind, what you're usually looking for, and you've probably heard in perhaps other business classes like management by exception, what you're looking for are the big numbers here. You don't want to be explaining every $20 difference. Okay. In fact, I've got a friend of mine that's an accountant, and he used to complain about his new accountants that would come on, and he'd go, they'd be looking for $20. And he goes, they'd spend hours looking for $20. And he goes, do you realize I pay you it's like $30 an hour? Just write it off. And so what we're looking for here are big numbers, you know, things that are outside of the realm of, you know, what have you. 830, 810, you'd probably just ignore that, you know? Okay. And usually, like I said, you look for percentages, because percentages are going to be a lot, you know, it could be a big number. It could be off by 10 grand, but 10 grand on $1 million is nothing. 10 grand on 20 grand is a huge percentage. So in one case, you'd look at it. In another case, you might just, you know, blow it off. Then finally, we have other. We have 980 and 850. Which is 130. That's unfavorable. And so we have total expenses. And total expenses are 21,680. and 20,580. So total expenses were 1,100. Unfavorable. Okay. And finally, we have net income, net operating income. And this is going to be the 35,200 minus the 21,680 for 13,520 and 11,420 and 2,100. And that, let's go, it's favorable. So the increase in revenue more than offset the unfavorable expenses. Questions? Let me just look here. I'm debating which one to do. Now we're going to put it all together. To put it all together, we're going to do exercise 9.4. Yep, we're going to do 9.4. And this will just take and put everything together for us. Okay. So we're going to have a, this is Vulcan. Let me just mark that it's 9.4. Oop. And we're on page 427. And this is an entire flexible budget performance report. So we're going to put Vulcan. And it is a flexible budget. Performance report. And this will be for the month ended on July 31st. Now notice what they have there on the table, what have you. They have the actual results, the flexible budget, and the planning budget. Okay, so what we're going to have here are a total of 5 columns. Okay, we're going to start over here with actual results. Then we're going to have revenue and spending variance. Which is what we just did on the other one. Then we're going to have our flexible budget. Then we're going to have our activity variances. And our planning budget. Now, we are going to end up doing calculations for the revenue and spending variance and the activity variance. Okay, those are the two where we're going to make calculations. The other three columns, all we're doing is copying them off the chart. Okay, so the other three columns, we're just copying those off the chart. We're not making any calculations for those. So we have actual results. The first thing are flights. Obviously, this is some sort of a airline or whatever. Okay, and we have 48, and 50, and I just copied those numbers off. Okay. And once again, I'm not going to use the formula. Okay, the formula that 320 times Q is only going to be used on the flexible budget and the planning budget. Okay, it's not going to be used on actual results. So I'm just going to go, this is going to be revenue. I'm going to just start by copying the numbers down and then we'll take a look. 13,650. Flexible budget is 15,360. And planning budget is 16 grand. Okay, now the difference between 16 grand and 15,360 is 640 bucks. Okay, and we thought we were going to do at the beginning of the year, whatever, 16,000. We only did 15,360. So that's unfavorable. So our activity variance, because we didn't do as much as we thought, our activity variance, okay, is unfavorable. And then when we flexed the budget and came up with that 15,360, our actual results were only 13,650, which is 1710, which is also unfavorable. That's a problem. Okay, and I'm going to say that's a problem because that is very large. That's over 10%. Okay, we thought we should have done, based upon the number of flights, 15,360. We only did 13,650. That's a 10% shortfall, over 10%. That's pretty big. Okay, so that is something we may want to look at for an explanation, what have you. Okay, why were we so far, what happened? Maybe they were all short flights, maybe there's some, but maybe it's because of some sort of, something we can fix. Now we're looking at expenses and we start with wages. Okay, and wages are 8430. 7936 and 8100. 8100 to 7936 is 164, and that's favorable. Okay, we were planning on 8100. We only spent 796. That's good. Okay. But then notice our flexible budget is 7936. We actually spent 8430. So this is going to be unfavorable by 494, which brings up a good point. Just because our revenue and spending variance is positive or negative, favorable or unfavorable, doesn't mean our activity variance is the same direction. Okay? Doesn't mean our activity variance is the same direction. Okay, and that would be another number, that 494 there, that's like 5% of revenue. Okay, that's like 5% of revenue. 10% would be 800. So it's like 5%. Once again, that's probably a pretty big number. Why are we so far off? I want an explanation for that. Okay, on to fuel. And for fuel, we have 1260, 1104. And 1150. So our activity variance is 46 bucks. Our revenue and spending variance, once again, is unfavorable. Okay, at 156. Okay, now, and I'm semi looking at my answer key here and trying to give you an idea on items that I'd be looking at and items that I wouldn't be looking at. The book says they wouldn't necessarily look at this item. Okay, and there may be one explanation that covers all of this. Their argument for not looking at it, it's 156 bucks. It's pretty small. And I will grant you it is. Okay. That being said, once again, it's a pretty big percentage. Okay. So, and maybe all these percentages, need to be looked at. But the next one kind of gives us a good example of one that you probably don't need to look at. So let's go ahead and put that one up just so we can kind of see airport fees. Okay, airport fees are $23.50, $24.74, and $25.50. So this one here is 76 bucks. Favorable. And $24.74, $23.50. Okay, that's $124, and that's favorable. Now, 124 bucks. It's not that big. It's also not big as a percentage. Okay, so I would probably ignore that one. I mean, it's a lot less than the 156 on 1260. It's a lot less than the fuel as a percentage. So that one I'd be less necessarily concerned about. That being said, I also want to point out, just because it's favorable and an expense, just like with my oyster beds, doesn't necessarily mean it's a good thing. It could be, but I want to look for big differences. Okay, things that I want explanations for. Just because it's an expense that wasn't as big as I thought it was going to be, and it's favorable, doesn't mean I shouldn't look at it. Okay, it doesn't mean I shouldn't look at it. So that's my airport fees. Depreciation, aircraft depreciation, aircraft depreciation, 336, 336, 350. It's $14 favorable. It's a big old goose egg. Nothing, nothing there to worry about really. Small numbers, what have you. So aircraft depreciation, office expense. And for office expense, I've got 460, 286, and 290. That's $4 favorable. And 174 unfavorable. Okay, once again, that 174 is not a big number in aggregate. Okay, compared to that 1710, but it's a huge percentage. Once again, 174 on 286, that's like 50%. Not a big number, but from a percentage wise, from a management standpoint, I may want somebody to look at it. Even though the number's not that big, the percentage is big. Okay, and maybe we hired a new employee, maybe we had overtime for some reason, or sick leave, or there could be a whole bunch of different reasons for it to be that that much of a difference. But I'm looking at it percentage wise, and I'm going, that's a pretty big percentage. Questions? Oh, that's not what I wanted. No. Total expenses. My total expenses were $12,836. 12,136 and 12,440. So this here is 136, $304 favorable. And total expenses, 700 unfavorable. And finally, I have net operating income and net operating 814. 3224 and 3560. And this one here is not very big. It is unfavorable, but that's, 336 unfavorable. It includes that 640 plus all of those. But the one over here, 2410, 2,410 unfavorable, is huge. Okay, we would have expected, if we had flown, I forgot how many flights we did. If we had done 48 flights, which is what we did, we should have expected to make 3224. We did 48 flights. We only made $814. That 2410 is huge. Okay, both in aggregate, as percentage, what have you. Hey, we need to do some. Yeah, we made money, but why were we so far off? And the things to look at were the items that I had already discussed. Questions? I am going to show you something in the textbook. I am going to go on to page 449 and 450 for next week. So I just want to point that out. And this, I think, is the easiest way to do it. Let's see what page I'm pulling up here. Like 449. I could do it. Let's go to 10.5. As you're going through for next week, okay, they're going to give you a bunch of formulas for this as you're doing the Learn Smart. And if this is the way you want to do it, that's fine. Okay. I may, going over homework next week, show you one like this. For the most part, I have always found the easiest, and I'm going to stay right on the same page. I'm just scrolling up here. I'm on exhibit 10.4. I've always found this to be the easiest way, to just put it in a table. Okay. And part of the reason is it's easy for me to remember. Okay. Actual on one side, actual quantity and actual price. And then on another side to put standard quantity and the standard price. And then in the middle to put the actual quantity and the standard price. I'm just saying, as you're going through the chapter, the chapter is going to give you two ways of looking at things. This is Mr. Sass's preferred method only because that's the way I learned it, and that's the way I'm familiar with. And I think that makes the most sense. If the formulas like this make sense to you, go for it. Okay. But I'm going to tell you in class next week, I am going to be doing things this way just because that's the easiest way for me to remember and to show you how it's done. Okay. And notice once again, you're completing variances, unfavorable and favorable. The only real difference then, if you will, from today is what we're going to be looking at next week is you were supposed to use a yard of cotton on the shirt. You used 1 yard and 1.2 yards. Why did you use 0.2? Okay, more. And part of it is, that, but part of it is you might have gotten a good deal. So what we're going to do is separate some of these variances, not only favorable and unfavorable, but into price and quantity. Is it because we got a great deal on the cotton? Or was it, we spent less per shirt than we should have? Did we figure out a way that we had less waste of cotton? Or did we get a better price? Okay, and so we'll be figuring out those types of items for direct materials, direct labor, manufacturing overhead, what have you. Questions? So for next week, we've got the chapter 9 assignment. In chapter 10, Learn Smart. And as I've mentioned, I'll be showing you the problems in that one format. So as you're going through and reading, just be aware of that. Okay. Any questions? I know a couple of you are already outside. For the rest of you, unless you're working, I don't want to get you fired or anything. Go enjoy the good weather. It's springtime.
It's a little